You are listening to The Vocal Technologist. Spoken tech for your ears.
You know, it's funny. We think about these huge, complex systems, but sometimes it's the simplest thing. That massive AWS outage, the one that took down Snapchat and Reddit for, like, millions of people.
Right.
It wasn't some sophisticated attack. It was just a single DNS problem. One little line of configuration.
It's kind of terrifying, isn't it? It's the perfect reminder of the scale we're all operating at now. We're in the middle of this colossal silent build-out, and its fragility is just directly tied to its size.
Exactly. And that's what we're going to unpack today. We're looking at the state of the startup world, from the infrastructure all the way to founder strategy. This is basically your briefing on what you need to know right now. And the place to start, I think, is just the scale, the shocking, mind-boggling scale of this cloud build-out. We're talking about Microsoft and Google. Together, they're sitting on $555 billion in cloud commitments.
Wow.
$555 billion. It's a number so big it almost doesn't mean anything.
And what's critical to get is that this isn't just, speculative spending. This is backed by real long-term demand. Microsoft, for instance, they're planning to expand their AI capacity by 80%.
80%.
And they want to double their data center footprint in just 2 years. Their commercial backlog is already over $400 billion.
And Google Cloud is what, $155 billion?
Exactly. So this isn't just growth. It's a total reshaping of the industry's foundation.
So when we talk about that kind of money, let's drill down into the physical side of it. You can't just wish for more compute power.
No, you have to build it.
And we're seeing that. Like Crusoe, that AI data center startup, they just raised $1.38 billion in a Series E.
At a $10 billion valuation.
Right. And they just fired up a new data center in Texas that's 1.2 gigawatts. That's a serious, tangible investment in steel and concrete.
And like you said at the start, that power is fragile. We just saw it with that AWS outage in US East 1.
In Virginia, yeah.
A seemingly small DNS problem with DynamoDB, and boom, massive global effects.
So if this AI growth keeps up, we're talking tens of gigawatts of new capacity coming online every year. What's the real choke point here?
Well, the constraints are shifting. The issue isn't just money anymore, obviously. It's power, materials, and skilled labor. The world literally needs more factories to build turbines and transformers. It needs hundreds of thousands of electricians and technicians to wire all this stuff up. And what's really striking is the priority shift. Speed now matters more than efficiency.
What do you mean by that?
It means natural gas is beating out nuclear and solar for new power right now. Because you can build a gas plant fast. They need to go, even if it costs more in the long run.
That pressure, that need for speed is forcing some really radical moves in product strategy, too. I mean, you see these household names just pivoting like crazy to survive. Did you see the Grammarly news?
The Superhuman deal, yeah.
They're rebranding the whole company to Superhuman after buying the email client.
That's a classic play, right? Moving from a niche tool to an entire ecosystem. They're not just about grammar anymore. Their new AI assistant, Superhuman Go, it connects to Jira, Google Calendar. They're trying to be a full productivity suite.
So they're going right up against Notion and Google Workspace.
It's a huge swing, but in this new world, I think you have to take those swings.
And then on the hardware side, you've got these massive gambles. Snap is trying to raise $1 billion.
$1 billion. Just for the AR glasses division.
Yeah. Evan Spiegel is apparently in talks with Saudi Arabia's public investment fund. That's not just an investment. That's a bet the company kind of move on a future that isn't even here yet.
And if you want to talk about corporate anxiety, let's look at Meta. This is fascinating. Their AI investments are clearly working. People are spending 10% more time on Instagram because the recommendations are better.
Okay, that's good.
And advertisers are paying 14% less per lead using their AI tools. Engagement is up, revenue is up.
Sounds like a home run, an absolute runaway success.
It should be, right?
But then their stock drops 8%. After all that good news?
Yeah.
I don't get it.
It's the Meta paradox. The stock dropped because expenses jumped 32%. Zuckerberg is just pouring money into AI research labs way faster than the revenue is growing. And investors are looking at this and saying, wait, why are you spending so aggressively when the current stuff is already working so well?
It's that tension between building for the future and rewarding investors right now.
Exactly.
Okay, so let's bring this down to earth.
Yeah.
If the giants are spending $500 billion and getting hammered for it, what does all this chaos mean for, the founder listening to this? Let's talk strategy. Starting with the absolute basics. Why pitches fail.
The number one killer, hands down, is trying to teach the investor everything.
The fire hose of slides.
The fire hose of slides, acronyms, backstory. You're a founder, you know every single detail, but they have 10 minutes.
It's the difference between trying to teach a history class and just sparking their curiosity.
Right.
A pitch is not about cramming information into their heads. It's about making them interested enough to ask for the next meeting.
100%. Simple problem, sharp solution, clear story. That's it. And that idea of a sharp solution ties right into finding product market fit, or PMF.
Which is, let's define that. It's
Yeah.
just being in a good market with a product that can actually satisfy that market.
Right. And where founders go wrong is they try to build this huge, sprawling vision right out of the gate.
The maximum viable product.
Exactly. The smarter move is to find your wedge.
That one single, tightly scoped problem that your small team can solve better than anyone on the planet.
Amazon started with books.
Facebook started with college photos. Nail that one small thing first. Earn the right to expand.
The story of Mercury's path to PMF is such a great example of this. Their big lesson wasn't about moving fast. It was about doing the hardest thing first.
What was the hardest thing for them?
Regulation. Founder Imad Hassan spent months just understanding the fintech regulatory landscape, how to build trust, all before they wrote any real code.
But hold on, doesn't that fly in the face of the whole move fast and break things mantra? Building slowly and deliberately.
Well, it's a paradox, right? They moved slowly on the code, but they moved incredibly fast on solving the core risk. They built it, they rebuilt it twice, and they only launched when they knew it was regulatorily sound and actually worked.
And what happened?
1,500 companies signed up in the first week. One company deposited $1 million without ever talking to a human.
Wow.
That's demand pulling you forward. That proves you solved the hard problem.
And that diligence has to extend into sales, too. If your first calls aren't turning into deals, just cranking up the volume isn't the answer.
Absolutely not. You have to shift from just tracking activity to tracking results. Use the data. Run your sales calls through an LLM to get transcripts. Demand structured feedback from your reps right after a call.
You need a scorecard.
Yes. A simple, consistent scorecard. Did they do good discovery? Did they identify real pain? Are there clear next steps? It tells you exactly where your reps are falling short so you can fix the process instead of just yelling, make more calls.
Okay, let's pivot to the other side of the money equation. Pricing. SaaS pricing feels like it's as much about psychology as it is about math. And the Slack example is just, it's perfect.
Oh, it's a classic. They charged only for active users, which sounded incredibly fair.
Super fair.
But it created this expectation, this mentality that price should be tied to usage.
And once buyers learn to ask what something costs you to run instead of what it's worth to them,
The game changes. Defending your value becomes so much harder. The conversation shifts from the incredible ROI you provide to your internal server costs, and you lose your pricing power.
So how do you fight that? How do you re-anchor the conversation on value?
You have to move toward outcome-based pricing. Stop talking about seats or credits. Instead, you price around the business result you deliver. A higher conversion rate, faster time to market, whatever it is. Anchor the price to the value they get, not the cost you have.
Shifting gears a bit to the internal side of things. There's a real cost founders pay. You see this all the time. The cult of busyness.
Ugh, yes, where exhaustion is like a status symbol.
Bad as honor.
It's performance art. It's the performance of productivity, and it's absolute poison for a company. Busyness is a sedative for anxiety. Founders are terrified of being irrelevant, so they just fill every second with motion.
And that just erodes any ability to think clearly.
Right. It prevents the deep strategic thought you actually need to guide the business.
So what's the antidote? Permission to be idle on purpose. What does that actually look like?
It means scheduled, protected time with literally no agenda. And I don't mean scrolling Instagram. I mean true intellectual quiet.
Walk with no phone.
Exactly. The gain is that you reconnect with the fundamental problem you're trying to solve. Busyness is tactical. Idleness is strategic.
It's a great contrast with this idea you mentioned, the divine lever.
Yeah, I love that concept. The divine lever is this idea that real success happens when your pursuit is just purely good. It's rooted entirely in serving a real demand. When you find that massive, unaddressed need, the effort feels effortless because the market is just pulling you forward. You aren't pushing against friction all the time. It's the ultimate cure for the cult of busyness.
Okay, one last tactical question for founders who are scaling up. When do you hire your first product manager, your first PM?
Before you have product market fit, the founder has to own the product, period. No one else has the vision.
But then you hit a wall.
You hit a wall. Your time is split between closing deals, pitching VCs, and trying to plan the next sprint. You hire a PM when all those feedback loops start multiplying and the tactical work synthesizing customer feedback, managing the backlog starts eating up all the time you need to be doing high-value strategic work.
So the PM becomes the great synthesizer.
Exactly.
This has been really, really good. We started with this massive, almost abstract number, $555 billion in infrastructure spending. But at the end of the day, success for an individual still comes down to the fundamentals. Finding your wedge, nailing PMF, and managing the psychology of it all.
The macro and the micro.
Right. And here's where I think it gets really interesting looking forward. There's this idea that the future of the web is basically just the history of YouTube.
Tell me more.
15 years ago, video creators were seen as, hobbyists. Now, they're media empires. Large language models are doing the same thing for software. They're letting anyone with a good idea build a real app without writing tons of code. It's opening up the long tail of software that was always too niche to build before.
So the people who drive this next wave won't necessarily look like traditional engineers?
I don't think so. I think they'll look a lot more like creators. People who understand audiences and storytelling and distribution.
People who just deeply understand a very specific problem that needs solving.
So the final thought for you listening is this. With this new accessibility, what's that niche problem you're holding on to? What's the audience you get better than anyone else? That might just be the next wave.
I love that. What's the fundamental rule you need to question? And what's the simple, hard problem you can lean into to find your own divine lever? Because that's where all the opportunity is hidden.
Spoken Tech, for your ears.